Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Last two videos I have completed the discussion on money market, unit number 3. First video I have explained the meaning of the term money market and what are the features of money market. And the second video I have explained about the functions of money market. Now in this video I'm going to explain you about organization of money market in India and also money market instruments. These two topics I am going to discuss in this video. So watch the video till the end to get the complete command. So more often and in examination a question will be asked regarding what are money market instruments or what are the functions of money market, features of money market. So if you have not watched the last two videos, go to the playlist of my channel. Select the subject financial institutions and markets. Watch unit number 3 money markets. Be perfect regarding the concept of money market. Now before starting the discussion on organization structure of money market in India, take the screenshot of the points which I have written on the board. Then I'll explain all the points in detail. Now, organization structure of money market in India. See here, in India, the money market can be divided into two sectors. That is organized sector and unorganized sector. So organization, Indian money markets organization structure comprised of two parts, namely organized and unorganized. Institutions which come directly or indirectly under the broad regulations of RBI constitute the organized sector. So what is this organized sector? All the institutions which are directly or indirectly governed by the provisions of the Central Bank of India, that is RBI. And those institutions which are under the control, under the provisions of RBI, that is called organized sector. And all the institutions which are outside the purview of the provisions of RBI, they will be in unorganized sector. So institutions that fall completely outside the purview of the central banking regulations make up the organized sector. So simple way we can understand like this. Organized sector, all institutions which are governed by the provisions of RBI are organized. All the institutions which are outside the purview of the provisions of RBI is called unorganized sector. And both the sectors are existing in India at present. First of all, we'll discuss which are the institutions which come under organized sector. So I told you the organized sector is also called the formal sector or regulated sector because these sectors are completely controlled by the provisions of RBI. It consists of RBI, commercial bank, cooperative bank, primary dealers, discount houses, LIC, UTI, and Industrial Development Bank of India, IDBI, SFC, State Financial Corporation, NABARD, National Bank for Agriculture and Rural Development. And the organized sector has been inadequate to meet the needs of trade and industry. So presently so many institutions comes under organized sector, but still the requirement, the need of the companies and industries in India will not be fulfilled by this organized sector. So comparing the requirement and this organized sector, the organized sector cannot be able to fulfill the total requirement of funds of all the industries in India. A well-developed money market will be closely integrated with global money market because after globalization, there is free flow of capital from one country to another country, whether short term or long term. So if the money market should be fully controlled, fully regulated, it should be integrated with global money market. Now unorganized. So I have explained you what are the institutions which come under organized sector, but still the major role is of unorganized sector only. So unorganized sector is outside the control of the central bank, that is outside the control of RBI. It comprises of indigenous bankers, money lenders, traders, commission agents, etc. So here we have seen which are the institutions which come under organized. Here the parties, the players in unorganized sector are indigenous bankers, money lenders, traders, commission agents, etc. Some of whom combine money lending with trade and other activities. Some of these participants will do double activity. They are doing the trading activity, along with that they are also doing money lending activity also. So the unorganized sector is characterized by lack of uniformity in their business dealings. They don't follow any systematic procedure of money lending. They are outside the purview of the law. That's why there is no uniformity in their dealings. Every businessman will deal in their own way. Now, in India, the indigenous bankers and money lenders are important segments of unorganized sector. So, in unorganized sector, the important players are money lenders and indigenous bankers. The Indian money market is dominated by unorganized sector. Still, even after so many years after independence, still majority of small business houses, small companies, small industries, they are dependent on this unorganized sector only. So still unorganized sector plays an important role in Indian economy, particularly in rural areas. So particularly in the rural areas, the indigenous bankers carry on their activities through cooperative credit societies. The first, participant in unorganized sector is the indigenous bankers. And these indigenous bankers will provide the finance by making credit cooperative societies. And one of the reasons for existence of unorganized sector is because of unaccounted or black money. Why this unorganized sector exists in India, and particularly in rural areas? The reason is unaccounted money or black money. The money which is not accounted, the government will not know about the source of income, how much they are earning, like that. Since unaccounted money cannot be deposited into bank, it is lent out in cash through informal channels at high rates of interest. This unaccounted money cannot be deposited in the bank. So what they will do? The money lenders or indigenous bankers or traders or commission agents, what they will do is they will deal the transactions in cash at a high rate of interest. That is the characteristic feature of unorganized sector of money market in India. So first topic we have completed, organization of money market, divided into organized and unorganized. The second topic in this video is regarding the money market instruments. The instruments means securities which are traded in the money market. The securities which are traded in the money market are called money market instruments. So in examination, they will ask you, explain few money market instruments. So you must remember. Now, the money market instrument are the securities which are traded in the organized sector of the money market. These securities give the right to the owner to receive a fixed sum of money on a specific date. When a person trades in money market instrument, this money market instrument gives the right to the owner to get a particular specified amount of money on a specific date. That means it's a proof that he is the owner of the instrument and he is eligible to get the amount on a particular date. The price at which these securities are traded is based on the rate of interest and the time remaining to maturity. How much amount the owner will get on the security? It depends on the rate of interest and also on the time period remaining for maturity. And these instruments are short-term in nature and can easily be converted into cash. All these instruments are short-term because in money market itself, only short-term instruments are dealt. So, the following are the important money market instruments. So, only two instruments I am going to discuss in this video. In the next video, remaining instruments I'll explain. The two instruments which are very important, very common in India are, first one, Treasury Bills. The first money market instrument, the famous money market instrument is Treasury Bills. It is commonly called as T-bills. The Treasury Bills are issued by the central government. First of all, you have to remember The treasury bills are the securities which are issued by the government. Secondly, these bills are typically issued for 91 days, although we also have 364 days T-bills and 182 days T-bills. Maximum period 364 days. So 364 days, 182 days, but commonly we will find the treasury bill of 91 days. And treasury bills are probably the safest instrument. If you compare the treasury bills with all other instruments, the treasury bill is the safest because it is issued by the government and there is no risk of default. Definitely the investor will get back his money. That is sure. That's why there is no default risk. It is the safest investment. And as there is no risk of default and the impact of interest rate changes is minimum. Whatever the changes in the interest rate, that won't have any effect on these treasury bills. Now, hence these instruments are very popular and very active in the money market. So most active instrument is treasury bills, and treasury bills are issued at a discount to face value. Normally we don't have any interest on this treasury bills. When the treasury bills are issued by the government, it will issue at a discount. Example, the face value of one treasury bill is, let it be 10,000. At the time of issue, the government will issue only at 8,000. Only at 8,000. That means the investor has to pay 8,000 rupees to the government for treasury bill. The duration of the bill 90 days. So at the end of 91 days, when the investor returns the treasury bills, he will get the face value. 10,000 he will get. So he has given to the government 8,000 and the government is giving him back 10,000. Remaining 2,000 rupees are the return on investment. Like this, the treasury bills are issued at a deep discount and redeemed at the par value, face value. Now, features of treasury bills. In examination, a short question may be asked. What do you mean by treasury bills and what are the features of treasury bills? I have explained you, treasury bills are the securities in money market which is issued by the government. This is the safest because there is no default risk and no impact of interest rate changes. The duration of the treasury bills normally is 91 days, but there are treasury bills which are of 364 days or 182 days. Now, features. Treasury bills are issued by GOI, Government of India. First feature. Second, RBI acts as an agent of central bank for issue of treasury bills. Directly, treasury bills will not be issued by the government. The government will appoint the agent. The agent is RBI. So RBI will collect the money of these treasury bills and give it to the government. So RBI is acting as an agent for collecting the money on treasury bills. Thirdly, treasury bills carry the highest safety with zero default risk. There is no default because who is taking your money? The government is taking. So government will return it back. So there is no question of any default by the government. Next one, treasury bills are short-term instrument issued for a maximum period of 1 year. 1 year or below 1 year. So normal duration of treasury bill is 91 days. But some treasury bills are there for 182 days or 364 days, but a maximum of 1 year. Next, treasury bills are discounted instruments. They are issued at a discount and redeemed at par. Just now I have given the example. There is no interest payment on treasury bill. The treasury bills are issued at a deep discount and redeemed at the par value, face value. Next is the minimum amount required for investment of treasury bill is 25,000 and in multiples of 25,000. So below 25,000 a person cannot invest in treasury bill. Minimum amount to be invested is 25,000 and in multiples of 25,000 means a person can invest either 25,000 or 50,000 or 75,000 or 1 lakh, like that. So these are few features of treasury bills. The second instrument, money market instrument, very famous money market instruments is commercial paper. Commonly it is called CP. The commercial papers are issued by corporates. What is the difference between treasury bill and commercial paper? Treasury bill are issued by the government. Commercial paper will be issued by the corporates, that is companies. And for a short period of up to 270 days, although 30 days CPs are more popular. So again it is less than 1 year. So the duration of the CP is 270 days. But there are CPs which are issued for 30 days and this is more common. And CPs are issued at a finance inventories to finance inventories and provide for temporary liabilities. So normally these CPs will be issued by corporates in order to finance the inventories or in order to meet the current liabilities. For example, a company is facing the problem of inventory. They don't have funds to purchase the inventory. So they will issue the CP and purchase and take the money. With the help of that money, they can purchase the inventory. Similarly, some companies which are facing the problem of liquidity, they don't have sufficient money to pay the liabilities, current liability. They will issue the CP, procure the amount and pay the current liability. Like T-bills, they are also discounted instruments. When the company issues the CP, it will be issued at a deep discount and on redemption, it will be paid the face value. Now, since they are issued by corporate, credit rating of the investment is very important. In case of treasury bills, it will be issued by the government. So people will have the faith on the government. So there is no default risk. But regarding the corporates, there is default risk. That means the investor may not know whether his money is safe or not. For that purpose, credit rating is very important for this CP. Only a company which is having high credit rating, those companies can only enter into money market and they can issue the CP. So every company cannot issue CP. High credit rating company can issue CP. Now what are the features of commercial paper? I have seen in the last examination question papers, many times this short question is asked. Explain about commercial paper and what are the features of commercial paper. So I have explained you the meaning of the term commercial paper. Now features. First feature, commercial papers are issued by corporates. It is not issued by the government. Secondly, commercial papers are discounted instruments. When the company issues the commercial paper, it will be issued at a deep discount with a promise that on maturity, the face value will be paid, par value will be given. CPs are unsecured, only corporates with high credit rating can issue CP. There may be some default risk attached in this CP. That's why only reputed companies, high credit rating companies can issue CP. Every company cannot issue. CPs are negotiable, they can easily be transferred from the buyer through endorsement. So it's a negotiable instrument. For example, I am having a CP. Easily I can transfer my CP in your name only by endorsement. So freely negotiable instrument, transferable instrument from one person to another person. CPs are issued for a minimum face value of 5 lakh and in multiples of 5 lakh. See the difference? In T-bills, treasury bills, the minimum amount of investment is 25,000 and in multiples of 25,000. Whereas in case of CP, the minimum amount denomination of one CP is 5 lakh rupees. And a person can invest in CP in multiples of 5 lakh. 5 lakh, 10 lakh, 15 lakh, 20 lakh, like that a person can make the investment in CP. And lastly, CPs are OTC, over the counter. Over the counter means it's a contract between two parties, the issuer and the buyer. They can directly issue to investor or through dealers. So these CPs can be issued directly by the company to the investor, or the CP can be issued through the dealers also. These are the features of CP. So in this video, I have explained you about the organization structure of money market in India, that is organized and unorganized. And secondly, I have explained two instruments which are used in money market, that is treasury bill and commercial papers. Inshallah, the remaining instruments I'll discuss in the next video.